When it comes to building wealth, few ideas are as simple or as powerful as John Bogle's. In this video, we're breaking down the Boglehead's guide to investing and the lazy portfolio approach that's helped millions grow their money with minimal stress, minimal costs, and zero need to time the market. Before we get started, hit like, subscribe, and tap the bell, because investing doesn't have to be complicated to be effective. From index fund basics to the exact asset mixes Bogleheads use, let's explore how this philosophy can help you invest smarter and sleep better. 10. What are Bogleheads and the lazy portfolio philosophy? The Bogleheads movement stems from John Bogle's revolutionary idea that most investors would be better off buying and holding low-cost index funds rather than trying to beat the market. A lazy portfolio is exactly what it sounds like: a simple, diversified portfolio that requires minimal maintenance and generates solid long-term returns. The core principle is that time in the market beats timing the market, and keeping costs low is one of the few things investors can actually control. This approach isn't about getting rich quick. It's about getting rich slowly and surely through the power of compound growth and broad market diversification. 9. The three-fund portfolio, the ultimate lazy portfolio. The most popular Boglehead strategy is the three-fund portfolio: a total stock market index fund, an international stock index fund, and a total bond market index fund. This simple mix covers almost every public company worldwide while adding bond stability. For younger investors, a common split is 60% US stocks, 30% international stocks, and 10% bonds, shifting toward more bonds with age. The advantage is owning thousands of companies through just 3 funds, with easy adjustments based on your risk and age. 8. Why index funds beat active management? John Bogle's research showed most actively managed funds fail to beat their benchmarks over time, especially after fees and taxes. Index funds track the market, offering lower costs and steadier returns. Active managers charge higher fees, trade frequently, triggering taxes, and underperform index funds about 80% of the time over 15 years. For example, if the market returns 10% yearly, but you pay 2% fees to an active manager, you lose 20% of your gains. Index funds charge just 0.03% to 0.2%, so you keep nearly all your market returns. 7. Asset allocation and age-based strategies. The Bogleheads focus on asset allocation over stock picking. A common rule is 110 minus your age for stocks, the rest in bonds. With longer lifespans and low rates, some use 120 minus age, or keep more stocks in retirement. The key is sticking to your plan through market ups and downs to avoid costly emotional decisions. 6. Dollar cost averaging and consistent investing. One of the most powerful aspects of the Bogleheads philosophy is consistent investing regardless of market conditions. Dollar cost averaging means investing the same amount of money at regular intervals, whether the market is up or down. This approach removes the impossible task of trying to time the market and ensures you buy more shares when prices are low and fewer when prices are high. The key is automation. Set up automatic transfers from your bank account to your investment accounts so you're consistently putting money to work without having to make emotional decisions. Even investing $500 per month can grow to substantial wealth over decades thanks to compound growth and the power of staying invested through all market cycles. 5. Rebalancing and portfolio maintenance. While lazy portfolios require minimal maintenance, they do need occasional rebalancing to maintain your target asset allocation. As stocks and bonds perform differently over time, your original allocation will drift. For example, if stocks have a great year, you might find yourself with 70% stocks when you wanted 60%. Rebalancing means selling some of the overperforming asset and buying more of the underperforming one to get back to your target. Most Bogleheads rebalance annually, or when allocations drift more than 5% from their targets. This disciplined approach forces you to sell high and buy low, which is exactly what successful investing requires, but what most people find emotionally difficult to do. 4. Tax efficiency and account placement. Smart Bogleheads think carefully about which funds to hold in which types of accounts. Tax-efficient index funds work great in taxable accounts, while bonds and REITs are better suited for tax-advantaged accounts like 400 and ONEX and IRAs. This is called asset location, and it can save you thousands of dollars in taxes over time. International funds generate foreign tax credits that are only valuable in taxable accounts, while bonds generate ordinary income that's better sheltered in retirement accounts. The goal is to minimize the tax drag on your overall portfolio while maintaining your desired asset allocation across all your accounts combined. 3. The power of low-cost investing. One of Jack Bogle's greatest insights was that investment costs compound against you over time. While a 1% or 2% fee might seem small, it can cost you hundreds of thousands of dollars over a 30-year investing career. Low-cost index funds typically charge between 0.03% and 0.2% annually, compared to actively managed funds that often charge 1% to 2%. This difference means keeping more of your returns working for you instead of paying fund managers. Bogle famously said that in investing, you get what you don't pay for, meaning lower costs directly translate to higher net returns for investors. This focus on minimizing fees is a cornerstone of the Bogleheads philosophy. 2. Behavioral investing and staying the course. The Bogleheads approach recognizes that successful investing is as much about psychology as it is about finance. Market volatility will test your resolve, and the media will constantly tempt you to make changes to your portfolio. The key is developing the discipline to stick with your plan during both market euphoria and panic. Historical data shows that investors who stay invested through market cycles dramatically outperform those who try to time entries and exits. This means ignoring daily market noise, avoiding the temptation to chase hot sectors or funds, and maintaining your regular investment schedule even when markets are declining. The most successful Bogleheads are often the most boring investors. 1. Common mistakes to avoid. The biggest mistake new Bogleheads make is overcomplicating their portfolios by adding unnecessary funds or trying to time the market. Another common error is abandoning the strategy during market downturns, which is exactly when you should be sticking to your plan and continuing to invest. Many investors also make the mistake of constantly tweaking their allocations based on recent performance or market predictions. The Bogleheads philosophy works precisely because it's boring and consistent. Resist the urge to make it exciting. Finally, don't get caught up in chasing slightly lower expense ratios if it means complicating your portfolio. The difference between a 0.03% and 0.1% expense ratio is minimal compared to the importance of staying invested and maintaining a simple, sustainable strategy. John Bogle's approach works because it's not about chasing the market. It's about owning it and letting time do the heavy lifting. Have you tried a lazy portfolio before? Drop your experience in the comments. And if you're new to index fund investing, let's talk about how to get started. If this video simplified investing for you, like, subscribe, and share it with someone who's overcomplicating their portfolio. Until next time, stay consistent, stay diversified, and let compounding do the work.